You don't believe the hype about the rotation, do you?
No, we are not fans of small caps. If anything, we'd be fading the bounce there. I mean, you don't want to be heading into an economic slowdown and Fed rate cuts with small caps as kind of your favorite position.
Why do you say that? Because some would make the case that that's where you want to lean into with the rate cuts coming and yields falling.
Yeah, so look, what we learned with the rate hikes was they work with it long and variable lags, and I think those rate cuts, which will be few and far apart, will also work with long and variable lags. So for small caps looking for relief, they might get it sometime next year.
So you continue to lean large. You think earnings this week from large cap tech sort of reverse what we've been seeing of late with the pullback of, reasonable size from the highs that these stocks hit not that long ago?
Yeah, I mean, I think you get maybe one day moves out of them, but I think the tricky part's going to be, look, at the end of the day, is AI going to make people want to buy more yoga pants, more cheeseburgers? I appreciate that, maybe tech companies want to spend, on AI, but I guess consumer companies, what does it mean for people buying things? I'm not sure it necessarily moves the needle when, people are struggling to buy, kind of a $5 value meal.
I mean, are you positive or negative on the overall economy? Because you want people to add to industrials and financials and materials, cyclical areas that would theoretically suggest you think the economy is going to remain reasonably strong.
Sure. So I would think about it as a barbell because we're unfavorable on small caps. We're unfavorable on consumer discretionary. We're unfavorable on real estate, right? So you've got some good sectors that are very cyclical, and then you've got some sectors that are really going to struggle in the coming months that are also cyclical. So it's a little bit of a barbell. Your
year-end target is what for the S&P? I have your S&P 500 midpoint at 5,200. What does that mean?
Yeah, so 51 to 53 is the year-end target range, and we're within, spitting distance now. We were also there kind of in the spring, and that's when we kind of started to sound a note of caution. Then you had a lot of these tech stocks going up, monsters tear, and it's not surprising at all to see them kind of revert back to where they were in the spring.
But, I mean, a lot of strategists are chasing the market higher. Why aren't you?
I mean, it's not served investors well historically to chase markets higher. At the end of the day, stocks do tend to kind of follow earnings revisions higher, not necessarily multiples higher. And I think from that standpoint, the tricky part is you're just not seeing earnings revisions move higher on some of these reports. Now, that could change after Q2 earnings are completely out. But at least right now, you're not seeing anybody, blow the doors off from an earnings standpoint.
I'm just saying what, you hear many investors talk about, and it's just don't fight the Fed. It worked well when they embarked on this whole thing initially with the rate hikes. Why wouldn't it work the exact same way in reverse as they embark on cuts?
And it could. I mean, we still have 2 months before the Fed cuts. We're not in the July camp. So, in 2 months, if there's a further pullback, if there's some more consolidation, if, let's say, earnings come through, I mean, we're looking for an opportunity. If things were to fall back into our target range, we could get interested.
But not if the market continues to go higher? It sounds like you're just skeptical that rate cuts are going to initiate the next leg of this rally.
I mean, I think if you had aggressive rate cuts or a true rate cut easing cycle start, then I think maybe we could get interested. The tricky part is from our standpoint, we only see what we would call kind of adjustment cuts, maybe 2 to 3, depending on, kind of how the economy is doing. If you are into kind of aggressive rate easing, something's gone very horribly wrong with the economy. And again, I go back to you want to be up in cap, up in quality, and kind of barbelled against some of those more consumer-oriented parts of the market.
Yeah, but I mean, aren't they just moving rates back to what, you would consider to be normal? They're still considerably higher than where for example, the rate of inflation is now.
Absolutely. That's where a lot of our caution comes from, is when you have real rates that are still positive, it doesn't, lead to a lot of relief for consumers, doesn't lead to a lot of relief for smaller companies or more indebted companies. So, yeah, that's exactly it, is they're not really going to do anything other than maybe take their foot off the accelerator.